So Booster Part 2. We've done a dive straight in with topic 1.3, revenue, costs and profit. Revenue, money coming in, sometimes known as receipts. Costs, fixed costs plus variable costs. Revenue take away costs equals profit. You need to try and remember this equation. You might want to try and remember it as a triangle. Revenue, price times quantity. For that part of the equation, take away costs, fixed and variable will equal profit. Got to try and remember this equation. Fixed costs could include things such as insurance, rent and salaries, and variable costs could include ingredients, wages and electricity. Quite often use bakeries, which is why I've got ingredients on there. Raw materials would be another variable cost. But essentially, just looking at that slide there, you need to try and commit as much of that to memory as you can. Fixed and variable costs, when it comes up, is normally worth a few marks. So this is a typical table, and you can see it's just looking at revenue, costs and profit, and it's worth 4 marks. What I would advise people to do whenever they are looking at a table like this, do May first. May doesn't require you in any way to rearrange any aspects of the formula. It is looking for, initially in May, revenue, take away, costs. And so it's all it's asking you to do is calculate total costs first of all. And therefore, once you've got all of the gaps filled in for May, then it means that you can check April and June against May. So what I'll ask you to do is pause, maybe go back and have a look at the previous slides, come back and have a go at trying to get these calculations correct. Hopefully you've had a go, and hopefully these are the answers that you have. If you haven't got these answers, look at the previous slide, work out what went wrong, because this is a really typical table that will come up. See how the numbers were calculated. This is another way that they could look at profit. They've done it before where they represented it as a graph, and they then asked you to provide some information about the graph. So if you have a look at the graph, and then we'll see what the answers are which are correct for this one. So this was just about the money available to the business. Now, as you can see over time, the amount of loss decreases and profit increases. So over that January to June period, they ultimately end up in profit. As a result of that, more money to invest in the business, and if you're going well, less likely or less risk of insolvency. Insolvency seems to have been a word over the past few weeks which my students have felt a little bit uncomfortable with. Bankruptcy, going bust, the business stopping, that's what insolvency is. Cash flow forecasts, if this comes up, it should be some reasonably easy marks for you as long as you remember the formula. Inflows minus outflows equals net cash flow plus opening balance equals closing balance. How to work it out is on the right hand side. I've said it, you should be praying for this to come up. It's an easy-ish formula to remember. You've just got to repeat it a few times tonight. Inflows minus outflows equals net cash flow plus opening balance equals closing balance. Make it second nature to yourself. The most difficult thing that's required is you potentially have to move the formula around a little bit, as you will see in this question. So there are 4 blanks: April, 2 in May and 1 in June. So fill in the blanks once you pause the video, and then we'll check back and have a look at the answers. So our answers are: first one, net cash flow 3,100, 17,000 takeaway 13,900. Our receipts, now this was where you needed to add total payments and net cash flow together, and that would have got you the 20,000. And then the closing balance is our opening balance plus net cash flow. And if you'd have looked at the June column, you might have been able to see the relationship between 8,500 and 5,100. So these two figures down here, those two together added towards that one. So even if you weren't sure what to be doing here, you might have, if you looked at this column, been able to find that relationship. And then finally, our last number is 2,000, our fixed costs here. And that was a process of looking at all of the payments, adding those two together, and then taking them away from that number. Again, it's trying to work out what the relationship is between the numbers. If you had any problems with that, just pause, do it again, have a look, really have a think about those numbers. Here's another question. This is a pretty unusual one about cash flow forecasts, and what it does in this question is that it asks you why. It's looking for the advantages of a cash flow forecast. So if you pause the video, we'll have a look at the answers in a second. So the advantages of looking at a cash flow forecast from the point of view of a bank. Now this is one of those questions where I am absolutely convinced that you could almost get it right by looking for the wrong answers. If you knew roughly that a cash flow forecast was about producing numbers, if you read A, producing some numbers removes all the risks. Of course it doesn't. That's a ridiculous answer. C, to see if Steve could add up figures properly. Surely a bank could just give him a test. This isn't a particularly successful way to get him. It just seems like a daft answer, and I'd hope that you could see that too. Finally, a legal requirement. Now, some of you, if you weren't sure on the advantage of this, might think that it's a legal requirement, but I'm hoping that you could have ruled out A and C, and at least would have been able to get 2 out of 3. Sources of finance. Memorise. Okay, short-term overdraft, trade credit, long-term profit, bank loan, venture capital, share capital, personal savings. Venture capital, think Dragon's Den. So people walk into the den, they say, I will give you 10% of my business if you will give me some money. Share capital, limited companies selling parts of their business, very similar to venture capital. Personal savings, obviously what the owner has, retained profit or profit. At the end of the year, you will put money back into the business. Bank loan, borrowing money from the bank. Overdraft, again borrowing money from the bank, but short term. And trade credit, where a supplier will give you stock for a certain amount of time before they expect you to pay. Have a go at this question. Should be reasonably easy. Stop the video now. No great surprise here. The information on the previous slide should really have helped you to be able to do this. And again, it shows you that if we look at D and E, they are the short term, which means the ones above are long term. And next year, a year after, they could ask a long term question, and then they could put any of these answers in as long term. It's easy to recycle this question for an examiner, so it wouldn't surprise me if it came up again. Marketing mix, price, product, place and promotion. I'm not sure how you say it. You want to remember it in the quickest way you can. I always remember price, product, place and promotion. It's easier for me to say, therefore easier for me to remember. Probably the most tricky price marketing mix question I've ever seen. 3 answers, examples of changes to the marketing mix. So you had to A, know what each 4 elements of the marketing mix were, then interpret whether these answers were price, product, place, promotion, or none of them. If it was none of them, it was a wrong answer. If it fit one of those price, product, place and promotion, then you had to select that as an answer. So this is a really tough one. Give yourself a few minutes and then we'll check out the answers. Offering to buy one and get one free. Okay, that is an example of promotion. Charging lower prices, an example of price. Introducing new items for sale, product. Employing additional workers, nothing. Primary research, nothing. And producing a yearly forecast isn't anything to do with the marketing mix. Now, as soon as you see limited or sole trader in the question, there is a high probability that that is absolutely critical. The distinction between sole trader and limited company is important. It can come up in the finance section with regards to appropriate sources of finance. It can come up here in this tax section. So, sole trader, owned by one person. Limited company, owned by shareholder or shareholders. As a result of that, sole trader, unlimited liability. You risk losing all of your personal possessions. Limited company, you're a limited liability and you only risk the money that was invested in the originally. 4 taxes: value added, income, national insurance contributions and corporation tax. One of the questions that people get wrong over and over again. The main difference that you are looking for here is income tax is paid by sole traders because they are the same as their business. So effectively the business has an income just like a person. Whereas corporation tax, you and the business are separate, not the same. And therefore the business has to pay its own tax. And that is corporation tax. So let's have a quick look at a question. This is a really, really common question. Pause, answer, and then we'll have a look at it. The key thing to look at here was Nelson's Limited. As soon as you saw that, you should have gone, right, corporation tax. So, and therefore, one of our answers straight away is corporation tax. Ruling out income tax and value added and national insurance contributions. The one that quite often doesn't get picked is national insurance contributions because it doesn't say tax at the end of it. But business tax and distribution tax do not exist. They will look to include taxes which don't exist. You are looking for the 4, and the only thing you're then looking for is it's a sole trader or limited, because if it's limited, it will be corporation tax. If it had been Nelson's was a sole trader, then you wouldn't have picked F and you would have picked A. Recruitment. Job descriptions, person specifications, application forms, and the way that you are allowed to discriminate against skills and attributes, so what people can do to the job. You can't discriminate against age, sex, race and disability. First question should be really, really straightforward. Have a quick look at it. Which things are workers protected from you discriminating against? Hopefully you didn't have a problem with that. Age and race. Next one. If you were applying for a job, what 3 things would you need to submit? Take a little bit of a longer look at this one. Okay, hopefully you've had a chance to have a look at this. 3 documents, curriculum vitae, many of you may have been doing them recently. Application form, you have to fill one of them up to try and get the job. And a covering letter which goes with your CV and your application form when you send them in. Person specification and job description are the things that the employer creates in order to make the decision, but it is not something that the candidate has to do. Person specification describes the person the business wants. Job description is a description of the job that the person will do. Quite often they will include them as part of a question and they will mix round, so it'll say person description or job specification. I've seen that before, so make sure you are looking out for those sorts of things. So the other 3 things, C, D and E, are things that the business does when they are trying to recruit. They identify the right people and then shortlist an interview. Exchange rates. Spiced. Strong pound, imports cheaper, exports dearer. Weak pound, imports dearer, exports cheaper. Whipperdeck. So, if you get an exchange rate question straight away, I want to see that annotated on the exam, spiced. If you realise that the pound is getting weaker, i.e. it buys less, then you change that to Whipperdeck by changing imports dearer, exports cheaper. This one, straight away, you can see that the pound is going from £1 to 1.77 to £1 is 1.55. It's a Whipperdeck question. So what is happening to imports? How will that affect the business? Hopefully I'd have a chance to have a look at that. Okay. Imports become dearer, therefore the cost of buying the case mix has just got more expensive. A. And D, if everything's just got more expensive, if you don't charge more, then you will make less profit. Didn't need to do any calculations, just needed to think about spiced and Whipperdeck. Supply and demand. Okay. What impact it has on price is when demand is high or supply is low, price will rise. And when demand is low and supply is high, price will fall. When you see the word commodity, it's a supply and demand question. The picture on the board is not a commodity. Sugar, oil, wheat, they're the kinds of things that are commodity. But this picture, it's a Picasso picture which sold for millions of pounds. Why did it sell? Because supply was low, so the price was high, and the number of people who wanted it, that demand was high, and therefore that's what created this record price for this Picasso. Question, pause the video, have a quick look. Industrial disputes in gold mines will mean that there is less gold, so less supply, therefore price will go up. Increased cost of mining gold means that people who make gold will stop producing it. This means supply will go down, cost will go up. And we have to pause the video at this point to try and make a business booster 3 for the last topic I've got on here.